Hello everyone. Welcome to the channel. Today we will explore Security Analysis by Benjamin Graham and David L. Dodd, a fundamental book for understanding investment analysis. Join me in this summary where we'll break down the most important lessons from each chapter, from the difference between investing and speculating, to how to find investment opportunities with a margin of safety. If you're interested in the world of investments and want to learn more with us, don't forget to subscribe to the channel and turn on the notification bell so you don't miss any of our upcoming videos. Let's get started. In the introduction, Graham and Dodd present the historical context of the book's publication, which emerged after the market crash of 1929 and the Great Depression. The extreme market volatility made it clear that the speculative approaches of the time had failed, highlighting the need for a more rigorous method for analyzing investments. The authors developed an approach that combines an in-depth analysis of financial statements with a prudent investment perspective, based on the intrinsic valuation of assets and the concept of a margin of safety. Chapter 1. The Nature and Concept of Investment. This chapter differentiates investment from speculation. For Graham and Dodd, an investment must be an operation where the investor has a solid basis for expecting the preservation of capital and an adequate return. In contrast, speculation is a bet without detailed analysis, exposing the investor to significant losses. The authors recommend focusing on the intrinsic value of assets instead of chasing price trends in the market. Chapter 2. Analysis of Bonds. In this chapter, the authors delve into how to assess the safety of bonds, which are debt securities issued by companies or governments. Graham and Dodd detail the importance of analyzing the issuing company's ability to generate sufficient income to cover interest payments and, eventually, repay the borrowed capital. The authors introduce the interest coverage ratio, which measures how many times earnings before interest and taxes, EBIT, cover interest payments. They also emphasize analyzing the stability of earnings and studying the industry in which the company operates to determine a bond's solidity. Chapter 3. Analysis of preferred stocks. Preferred stocks are hybrid securities that combine features of debt and equity. Although they offer a fixed return, they are subordinated to bonds in case of bankruptcy. Graham and Dodd explain that the analysis of preferred stocks focuses on the stability of earnings and the company's ability to pay the promised dividends. The authors suggest that preferred stocks are only attractive if their yield significantly exceeds that of the company's bonds, thereby compensating for the higher risk. Chapter 4. Analysis of Common Stocks. The analysis of common stocks is presented as a greater challenge, as these do not offer a fixed return and their value depends on the long-term performance of the company's earnings. The authors emphasize that analyzing common stocks should include a study of the company's history, the stability of its earnings, and its dividend policy. Graham and Dodd recommend analyzing companies that show a consistent track record of earnings growth, but warn against overpaying for future expectations that lack a solid foundation in the company's fundamentals. Chapter 5. Earnings Valuation. This chapter details how to evaluate a company's profitability based on its earnings history. The authors argue that past earnings are not always a reliable indicator of future results, making it important to adjust historical earnings to reflect a conservative view of profitability. They also suggest excluding exceptional earnings from calculations, as these are not expected to recur, helping to avoid overestimating a company's potential. Chapter 6. Dividend Analysis. Graham and Dodd highlight the importance of dividends as a sign of a company's financial stability. A consistent dividend policy reflects management's focus on stability and shareholder returns. Dividend analysis can also provide insights into the sustainability of a company's earnings and its commitment to shareholders. However, the authors acknowledge that some high-growth companies may choose to reinvest their earnings rather than distribute them, and in such cases, investors should evaluate whether the reinvestment generates an adequate return. Chapter 7. Asset Valuation. This chapter focuses on evaluating a company's assets as part of its intrinsic value. Graham and Dodd explain how to calculate a company's value by considering its tangible assets, such as real estate, equipment, and inventory, and subtracting its debts and liabilities. Asset valuation is especially useful in analyzing companies in liquidation or those with a high proportion of liquid assets. The authors point out that sometimes the market underestimates the value of a company's assets, creating opportunities for investors who conduct detailed analysis. Chapter 8: Margin of Safety. The margin of safety is one of the book's core principles and a cornerstone of Graham's investment philosophy. It represents the difference between an asset's calculated value, intrinsic value, and its market price. A wide margin of safety provides protection against analysis errors, unexpected variations in company performance, or adverse external events. According to the authors, this margin is key to successful long-term investing, as it minimizes the risk of permanent capital loss. Chapter 9: The Importance of Quantitative Analysis. This chapter highlights the value of quantitative analysis, which involves a detailed study of the figures in financial statements. Graham and Dodd argue that while qualitative factors are important, numerical analysis is essential to understand a company's true financial position. Analyzing metrics such as the price-earnings, P/E ratio, price-to-book, P/B ratio, and return on equity, ROE, can help identify undervalued companies in the market. Chapter 10: The Value of Information in Markets. In this chapter, the authors challenge the idea that markets are always efficient, a theory which posits that stock prices reflect all available information. Graham and Dodd argue that there are inefficiencies in the markets that investors can exploit through in-depth analysis. They suggest that by identifying discrepancies between a company's market price and its intrinsic value, it's possible to find attractive investment opportunities. Chapter 11: The Role of Qualitative Analysis. Although quantitative analysis is central, Graham and Dodd recognize the importance of qualitative factors, such as management quality, the company's position within its industry, and the strength of its business model. Competent management and competitive advantages can significantly influence a company's long-term performance. However, they warn against relying solely on qualitative factors without quantitative backing, as this can lead to overvaluation. Chapter 12: Growth Evaluation. This chapter focuses on evaluating companies that promise significant growth. Graham and Dodd caution that growth projections are inherently uncertain and that investors should be conservative when incorporating growth expectations into their analyses. They recommend avoiding paying high prices for growth companies, as these expectations are often overvalued in the market and can lead to disappointments. Chapter 13: Economic Cycle Analysis. The authors discuss how economic cycles affect companies and their financial results. They suggest that analyzing a company should consider the phase of the economic cycle in which its industry operates. Cyclical companies, such as manufacturers, can have highly variable performance depending on the general economy, making it crucial to adjust earnings projections and value calculations to reflect these fluctuations. Chapter 14: Analysis of Low-Priced Companies. This chapter describes the methodology for finding and analyzing stocks of companies trading at low prices compared to their book value or assets. Graham and Dodd emphasize that these stocks, often overlooked by the market, can be a source of superior returns if identified correctly. However, they stress the need to thoroughly analyze the reasons behind a stock's undervaluation to avoid value traps. Chapter 15: Investment Selection Criteria. Here, Graham and Dodd present a set of criteria that investors can use to select stocks and bonds. These include the price-earnings ratio, earnings stability, capital structure strength, and dividend policy. They propose using these filters to identify companies that offer a good balance between risk and return, allowing for a more robust portfolio. Chapter 16: Perspectives for the Conservative Investor. In the final chapter, the authors reflect on the importance of patience and discipline for conservative investors. They emphasize that the investor should maintain a long-term perspective, avoiding being swayed by short-term market fluctuations. The key, according to Graham and Dodd, is to stay true to a value-based approach, always seeking an adequate margin of safety to protect against market uncertainties. And that's all for today. I hope this summary has been helpful in better understanding the key concepts of security analysis. If you enjoyed the content and want more analyses like this, don't forget to subscribe to the channel, give it a like, and activate the notification bell so you don't miss any of our upcoming videos. See you in the next one.